Have you ever wondered when the U.S. Federal Reserve will cut interest rates? Today we delve into this pressing question. It's a fascinating topic, one that has the power to directly impact the financial landscape from Wall Street to Main Street. Interest rates set by the Federal Reserve can affect everything from the returns on your savings account to the cost of your home loan. Therefore, predictions about rate cuts are of immense interest to a wide array of individuals and businesses. But predicting when the Federal Reserve will cut rates is no simple task. It depends on a multitude of factors, including the state of the economy, inflation rates, and even global political events. When economic growth begins to slow, or inflation remains stubbornly low, the Federal Reserve might decide to cut rates in an attempt to stimulate economic activity. Trade tensions and geopolitical events can also influence the central bank's decision. It's a complex equation, and we're here to help you understand it better. In the current economic scenario, the U.S. economy is showing signs of a slowdown. This, coupled with other factors, could potentially prompt the Fed to cut rates in the near future. But to get a clearer picture, we'll need to delve deeper into the specifics. In this video, we'll explore the factors that influence the Federal Reserve's decision, examine the current economic indicators, and hear from economists and financial advisors about their predictions. We'll also discuss the potential implications of a rate cut, so you can understand what it might mean for you and your financial decisions. So buckle up and get ready for a deep dive into the world of interest rates, central banking, and economic predictions. Stay tuned as we unravel the insights and predictions from economic experts on this crucial topic. Before we delve into predictions, it's vital to understand the Federal Reserve's role in steering the economy. The Federal Reserve, often simply referred to as the Fed, is the central banking system of the United States. Its primary function is to regulate the nation's money supply and stabilize its financial system. But how does it do that? The Fed operates under what's known as a dual mandate. This means it has two main objectives: to maintain maximum employment and to keep prices stable, which it does by controlling inflation. Let's break that down. Maximum employment doesn't mean zero unemployment. Rather, it refers to the highest level of employment that the economy can sustain while keeping inflation in check. The Fed doesn't specify an exact unemployment rate to target, as this can change based on a variety of factors. Instead, it monitors a range of indicators, including job gains, labor force participation, and wage growth. Now, on to inflation. The Fed aims to keep inflation at around 2% per year. Why 2%? It's seen as a sweet spot that allows the economy to grow without prices rising too quickly. The Fed uses interest rates as a tool to control inflation. If inflation is too high, it might raise interest rates to slow down the economy. Conversely, if inflation is too low, it may cut rates to stimulate economic activity. So the Fed's decisions on interest rates are heavily influenced by its dual mandate. It's a delicate balancing act trying to maximize employment while keeping inflation under control. The state of the economy, therefore, plays a significant role in these decisions. With this knowledge, we can now delve deeper into the current economic indicators that may signal a rate cut. The current economic indicators give us clues about the potential timing of an interest rate adjustment. Let's unpack these indicators to get a clearer picture. Starting with gross domestic product, or GDP growth, it is a key measure of economic health. When GDP growth begins to slow, it can be an early signal that the economy is weakening. In such cases, the Federal Reserve might opt to cut interest rates to stimulate economic activity. Next, let's consider consumer spending. Consumer spending accounts for about 70% of the U.S. economy. Therefore, when consumers pull back on spending, it can lead to a slowdown in economic growth. A downturn in consumer spending could prompt the Federal Reserve to cut rates to encourage borrowing and spending. Wage growth is another important economic indicator. When wages are growing, consumers have more money to spend, which can boost the economy. However, stagnant or declining wages can indicate a weakening economy. In such a scenario, a rate cut can be on the cards to stimulate economic activity. Turning our attention to inflation rates, the Federal Reserve has a target inflation rate of around 2%. If inflation remains persistently below this target, it could indicate that the economy is underperforming. This could provide the Federal Reserve with a reason to lower rates in an attempt to stimulate inflation. Lastly, we look at manufacturing activity. A contraction in this sector can be a red flag for the economy. The Federal Reserve might respond to a contraction in manufacturing activity with a rate cut to stimulate economic growth. These indicators provide a snapshot of the economy, which the Federal Reserve considers when making rate decisions. By keeping a close eye on these indicators, you can get a sense of when a rate cut might be on the horizon. Economists and financial advisors have their own predictions about when a rate cut might occur. Insights from these professionals are vital as they have an in-depth understanding of the economy and the financial markets. They analyze various factors such as inflation, economic growth, and trade tensions to make predictions about the Federal Reserve's actions. For instance, experts at Nomura, a highly respected global financial services group, believe that the U.S. Federal Reserve might not just halt its aggressive rate hikes, but also cut rates altogether. They attribute this potential move to the ongoing U.S. banking crisis and the looming financial stability risks. These economists predict a cut in the benchmark interest rate by 25 basis points at an upcoming meeting. Their conjecture is based on the recent collapse of Silicon Valley Bank and Signature Bank, New York, which has rattled the banking sector and sparked fears of a broader financial crisis. Other high-profile experts, including those at Goldman Sachs, also expect the Federal Reserve to step back from its aggressive rate hikes. They believe that a rate cut, while not a solution for the banks, could reduce the risk of further bank runs and alleviate unrealized capital losses. Moreover, there's an anticipation that if the Federal Reserve signals lower rates in the future, markets could quickly price in further rate cuts. Therefore, it is essential to keep an eye on the signals from the Federal Reserve as they can influence market behavior. On the other hand, some experts suggest caution. Federal Reserve Governor Christopher Waller has indicated that there is no immediate need for additional rate increases, citing recent economic data. He suggested that the Fed can proceed cautiously with further interest rate hikes, which implies that any drastic cuts would be unexpected. But things could change. Investors are awaiting more information from the Fed to determine if there will be more interest rate hikes, despite signs of falling inflation. Therefore, the timing of a rate cut could be influenced by future economic data and the Fed's interpretation of it. In conclusion, while there are varying viewpoints, most experts agree that the economic conditions, including the state of the banking sector and inflation rates, will play a significant role in determining whether and when the Federal Reserve will cut interest rates. These expert viewpoints provide a nuanced understanding of the potential timing of a rate cut. A rate cut by the Federal Reserve has significant implications for the economy and individuals. Imagine the economy as a vast sea and the Federal Reserve's interest rate as the tide. When the tide, or in this case, the interest rate goes down, it sets off a ripple effect across the whole sea of economy. Let's begin by looking at the broader economic implications. A rate cut is typically seen as a stimulative monetary policy measure. It lowers the cost of borrowing, encouraging businesses and consumers to take on more debt for spending and investment. This, in turn, can stimulate economic growth. If the economy is facing a slowdown or recession, a rate cut can provide the necessary boost to help it recover. But what about businesses? Well, businesses can benefit substantially from a rate cut. It reduces their borrowing costs, making it cheaper for them to finance new projects, expand operations, or hire more staff. However, it's not all sunshine and rainbows. Lower interest rates can also lead to thinner profit margins for banks and other financial institutions, as they earn less from lending. Now let's turn our attention to the implications for individuals. A rate cut can be a mixed bag. On one hand, it can make loans, such as mortgages and car loans, cheaper. This can potentially make it easier for individuals to buy homes, cars, or other goods. On the other hand, savers might not be too thrilled. Lower interest rates mean they earn less on their savings accounts and other interest-bearing investments. Investors, too, have to navigate these changing tides. Lower interest rates can make bonds less attractive, as they offer lower yields. This could push investors towards riskier assets, like stocks, in search of higher returns. However, this could also inflate asset prices, leading to potential bubbles. Thus, a rate cut by the Federal Reserve is not merely a change in a number. It's a lever that moves various cogs in the economy, businesses, and our personal finances. It's like a change in the wind direction, It might not be immediately noticeable, but its effects can be far-reaching and profound. Understanding these implications can help us prepare for a potential rate cut. As the saying goes, forewarned is forearmed. By understanding these potential implications, we can better steer our ships in this vast economic sea. Navigating these waters might not always be smooth sailing, but with the right knowledge and preparation, we can weather any storm. We've taken a deep dive into the potential timing of a US Fed interest rate cut. We've explored a multitude of factors, all pivotal in shaping the Federal Reserve's decisions. Let's take a moment to recap our journey. We started by understanding the role of the Federal Reserve, the central banking system of the United States. Its mandate involves balancing employment and inflation, a task that requires a delicate hand and an eye for detail. We then turned our focus to the vital economic indicators. The health of the economy, indicated by factors such as GDP growth, consumer spending, wage growth, and manufacturing activity, plays a significant role in determining if a rate cut is on the horizon. We also considered inflation rates, another significant piece of the puzzle. If inflation remains low and below the Fed's target, it could be a catalyst for a rate cut. Our exploration led us to the insights of distinguished economists, financial advisors, and market analysts. Their predictions, while not foolproof, are based on years of experience and deep knowledge of economic trends and patterns. Finally, we pondered over the potential implications of a rate cut. A lower interest rate could stimulate economic growth by making borrowing cheaper, but it could also lead to inflation if not managed carefully. Let's remember, the exact timing of a rate cut is an intricate dance, choreographed by a multitude of dynamic factors. It's a dance that's constantly evolving, shaped by the beat of the global economy, the rhythm of domestic financial stability, and the tempo of inflation and employment rates. So while we can make educated guesses based on these factors, the precise moment remains in the hands of the Federal Reserve. Our best course of action? Stay informed, stay prepared. The more we understand, the better we can navigate the financial landscape, making informed decisions that protect and grow our investments. Remember, while predictions can guide us, the exact timing of a rate cut depends on various dynamic factors. Stay informed, stay prepared.